Hello and welcome to our latest Insider interview. Today in the studio I have with me Nicholls, who is Fund Manager of the Fidelity China Special Situations Investment Trust. Dale, thanks for coming in today.
Thanks, Kyle. Great to be here.
So Dale, the Trust invests in both listed and unlisted businesses, and it seeks to profit from the rise in the middle class in China and also China's shift towards a more consumption-driven economy. So how do you narrow down the universe to invest in a selection of companies that are seeking to profit from those trends?
Yeah, I don't know if there's an easy answer for that. We're constantly on the ground looking for the companies that are going to be the leaders over the long term. So following, consumption trends, looking at sort of, the sales numbers that are coming through. And to be honest, just constantly meeting with companies, understanding a company's strategy, and just sort of, I guess, really understanding the competitive advantage, how sustainable that is, and how that feeds into sort of the growth prospects over the middle term. So, it's really about, the team on the ground, working away, finding the best ideas.
I can see there's a couple of unlisted stocks in your top 10 holdings.
Right.
What's the overall exposure and how do you manage risk?
Yeah, our exposure to unlisteds right now would be around 15%. We really try to employ the same approach when we're looking at the unlisted companies. I think, the only thing that's different is, the risk-reward prospects are generally different. So, I think generally with earlier stage companies, the risk is probably higher, and therefore we expect, higher returns to really compensate for that. Oftentimes, there's probably not the same level of information you can have for listed companies. So that, again, requires more work from the analyst team to gain comfort around the fundamentals for a business. But outside of that, I think the approach is pretty much the same.
Two sectors that you have notably more exposure to than the index are
Right.
industrials and technology.
Sure.
Could you talk us through the attractions of both of those sectors and name a couple of stock examples?
Yeah, sure, absolutely. So in the tech sector, it's actually pretty broad. So, you're going to have the consumer element in terms of consumer tech. You've also got, in many cases, a more business-focused, B2B type, focused type businesses. But, there's good growth prospects in both sides. I think thinking about consumption in general, we know that's going to occupy a bigger part of the economy over time. It's clearly, a focus for the government to be focused on quality growth driven by consumption. So that will naturally expand. But I mean, it's just the natural development of the middle class is a really strong underlying theme in China. And there's many companies out there that are going to benefit from that. I'd also say, it's a kind of a unique time in tech because obviously we've been through harsher regulation, which has really impacted valuations in the sector. So valuations are lower. That's offer the opportunity to increase the weight in the sector as well. Particularly now that I think the regulatory storm is starting to ease. And then elsewhere in tech, as I mentioned, you've got the business side as well, which a lot of businesses have really good prospects there as well. If you look at things like cloud penetration, the potential for software, there's some really good growth opportunities there as well. And then in industrials, there's, I think, a pretty clear broader economic recovery underway. I think there's good potential for, the overall economy to accelerate from here. And there's a lot of industrials that'll, I think are set to benefit from that. Again, it's a broad sector. So you'll have areas like building materials that I think will benefit from an improving property market. It's obviously been through a tough time and a lot of the stocks have been weak on the back of that. But I think the prospects, are there for that to improve. But I also see just generally a lot more quality industrials in China, companies that are really investing in R&D and bringing out quality products and in many cases taking share from international players. So there's I think a pretty strong story around import substitution in China as well for a lot of the industrials.
Are you able to pick out one example for each of those sectors?
I'd say in the industrial space, there's a company called SK Hsu in the paint sector. Again, which may not sound so exciting, but I think is actually a pretty compelling story over the midterm. We talked about the potential for the property sector to improve, but across a lot of areas of building materials, you've got very fragmented markets. We're talking about markets where your top three players can be maybe 20% of the market, whereas in the West, it's more like 80%. And just given the tough times that we've been through, consolidation is very much underway, and we're seeing the winners emerge in that space. So someone like SK Shoe, which is the number 2 player, a foreign player being the biggest, I think has good potential to really significantly grow over time, both in the B2B side of the business, but also in the consumer side as well, directly to the consumer, where you can, the paint business is actually quite a good business. You can develop a brand, get pricing power, and thus generate pretty good returns on capital. So I think that's a good example of a company that can be much bigger over the midterm, given their prospects and their positioning in the market. To think of an example in the tech space, it's somewhat consumer related as well, but there's a company called Autohome, which is really a leader in this sort of auto advertising vertical. So they're a real dominant player in that space. I actually think the prospects are pretty good for improvement in the auto market. With reopening, I think demand probably picks up there, and at the same time, you've got, I think, pretty good prospects of increased competition. You've got new players in the electric vehicle space. The incumbents are bringing out new product in that space as well. So I think as competition increases, advertising will be important, and they've got quite a strong position in that market. So they'll set to benefit from that. They've also got a pretty strong business in the used car market, and that's a market that has I think pretty good prospects to grow in China. It has lagged. It's been much more driven by new cars, but I think the used car part of the market has pretty good prospects to grow there as well. And it's another name that I think has sort of been brought down by the sort of overall tech sell-off with concerns around regulation, but it's clearly a good business generating good cash flow and set to benefit from improving fundamentals.
The trust makes active use of gearing.
Right.
Have those gearing levels been increased recently to take advantage of the lower valuations?
Yeah, I mean, the gearing really did pick up when the market was weaker, because I was definitely putting more capital to work when sort of late last year when things got really cheap. Gearing levels now have actually come down. So I have taken some money off the table in the names that have done really well. I'd probably cite the more obvious reopening plays, things like travel-related, stocks and that sort of thing, where clearly they're the natural beneficiaries of reopening, and in many cases, I think a lot of the improving fundamentals have been reflected in stock prices. So, we've actually taken down the gearing. It's still relatively high. I still think the prospects are pretty good, but maybe not as compelling as it was a few months back.
There's a team of on-the-ground analysts.
Right.
How important is it meeting company management face-to-face?
Yeah, no, it's very important. It's a core part of our process. I think it's important to, go to company headquarters, see factories, that sort of thing. There is, we've been through a period where that's been made difficult. It's still important, and we're very lucky that we've had a team on the ground, through the pandemic. So they've been able to meet with companies, whereas I think a lot of companies have struggled to get that real sort of on the ground flavor by through not having that on the ground team. So it's great that we've had that team on the ground.
And for investors considering exposure to China, how would you convince them to pick a single country strategy like yourself,
Right,
over an emerging market or an Asia Pacific fund, which typically they do tend to have quite a bit of exposure to China?
Yeah, I think pure China exposure is something that's, I mean, when I think about the Chinese market, it's unique in many ways. It's a market that tends to get driven a lot by the headlines, whether it's geopolitical, whether it's economic, it tends to be in the headlines, and that can really create volatility in the market. Sort of an individual stock picker that can create a lot of opportunity in the market. So it's quite a good stock picking market in that sense. It will continue to grow and probably outgrow sort of global growth. And at the same time, if you look at investor positioning, it's still pretty clearly underweight. Definitely, the weighting is minuscule compared to if you think about sort of China's weight as a percentage of global GDP. So there's good prospects, I think, for investors to be owning more of China over time. So I think that's likely to be a tailwind as well.
And finally, do you eat your own cooking? Do you have personal investments in the trust?
I do, absolutely, and it did increase over the past 12 months when we saw things really sell off.
Well, that's good to hear. Dale, thanks for coming in today.
Thanks, Kyle.
That's all we have time for today. You can check out the rest of our insider interview on our YouTube channel, where you can like and subscribe. Hopefully, see you next time.